Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 3 weeks ago I highlighted a new view of what I thought was an earlier pattern. No longer a very large double bottom pattern, instead a July 24 to date rectangle pattern. Currently 952 to 1094, highlighted in bright pink on my daily chart. The top side for this pattern is still capped by the 50% Fibonacci line of the May to August 2024 move at 1098 and the 61.8% absolute Fibonacci line at 1106. Separate to this, I brought up 4 weeks ago the idea of a February to date descending wedge pattern, highlighted in bright green on my daily chart. My comments from 4 weeks ago included, and I quote, "A break from this pattern when it comes will be very interesting, as if it were higher than the 50% Fibonacci line and the 61.8% absolute Fibonacci line overhead would be under threat, whilst the break lower would run into congestion seen mainly between the mid-October 24 to mid-January 25 in the 990 zone, assume of course it pushes past the dark blue neckline extension of the late July, late August reverse, that extension is at 1017, of the late July to late August reverse head and shoulders pattern," end of quote. Well, 3 weeks ago, and again 2 weeks ago, we had breaks lower and prices dropped down to 991 and 994 respectively. The first only easily within the influence of what I had said was, and I quote, "the congestion seen mainly between mid-October 24 to mid-January 25 in the 990 zone," end of quote. And the second, well, possibly within the same sphere of influence. However, with changeover, we were back up testing from the top side the combination of the flatlining mauve medium moving average, currently at 1021, and the dark blue neckline extensions. Now, we have left a sort of mini double bottom formed over the start of March, but I'm not designating it as such because, as I said last week, and I quote, "I suspect we may extend that into a possible bearish cat's ears pattern, so I'll leave it for now. However, the 990 support is worrisome for anyone looking on the downside. I say this because the primary target on the downside for the small bright green descending wedge pattern has already been achieved, as it wasn't too far below the break lower, down at the 1011 level. However, the secondary hard to reach target X is down at 966, below the key 990 level and just above the purple uptrend, currently at 959, of the 2019 to date uptrend, and the more recent pink August 24 to date uptrend, currently at 952. I think a lot will depend on whether the market manages now to move back below this dark blue neckline," end of quote. That's a long quote, quite a long quote, with quite a lot to unpack there. So what have we seen since? Well, a slow, very slow grind lower below the mauve medium moving average and the dark blue neckline and filling in the changeover gap, but it has been painful to watch. We are at the end of the bright green descending wedge pattern, but even with yesterday's unusual key reversal down, we seem to be in no hurry to try down to target X at 966, and even in no hurry to attempt to move to the closest support at 990. However, overall, the big picture, we are still well within the large July 24 to date rectangle pattern right now. Chicago soybean meal. The main recent pattern driver here in this market had been and is still just about the dark blue May to October 2024 bearish shift pitch walk. The market is running for a third time back below the overhead upper time, currently at 305.30 after breaching it last week with changeover. This pattern had previously been breached on the upside in January, but had not been broken, and it had at the time also been reinforced by a congestion area further overhead between 323.30 to 326.90, as well as the declining gold long moving average, currently 313.60. Last week, with changeover, prices opened over the dark blue upper time, but the gold long moving average did a splendid job in capping the rise, especially on Monday last week. It's really quite extraordinary there, and we are back below the bearish shift pitchfork as well as under the green short medium moving average, currently at 306.40. However, the market has to deal with the mauve medium moving average now, which is currently at 301.90, which originally was a bearish presence, but has changed to become a possible support, though yesterday we did indeed close just below it. So I'll be interested to see how the market deals with it for the rest of this week. Now, overhead we have the interesting bright green mid-December 24 to early February 25 lower bull channel come lower trend line to an ascending wedge pattern, currently at 327.10, plus below the purple lopsided head and shoulders top pattern's neckline, which is currently at 325. I don't think I've I've still got it marked on there as purple. 5 weeks ago, prices dropped down below both, and as I said 4 weeks ago, and I quote, sets up some opportunities on the downside for an ascending wedge pattern. There is a primary target X down in the 293.80 zone, excuse me, and a secondary harder to reach target X1 down in the 265.60 zone. For a head and shoulders top pattern, we have a primary target X2 down in the 293.30 zone and a secondary harder to reach target X3 down in the 280.10 zone. End of quote. Now I further added that, and I quote, looking at the targets, the primary targets X and X2 are doable, but still within the congestion seen back in April to August 2020 between 282 even to 300, and again most recently in November and December last year. However, the secondary targets for both are below the congestion and thus harder, much harder to attain. End of quote. We are still gradually approaching this 282 to 300 congestion support. 3 weeks ago, upon reflection, I did an interim target X4 in the 285.30 zone below for the ascending wedge pattern. And 3 weeks ago, we also saw both target X, the primary target, and target X2, the other primary target, achieved, followed by a reactionary move back up. This move back up created back then a weekly key reversal up, which has seen a small move higher since, including a small bull flag, but which has not lived up to its potential, and I'll be retiring as an impactful event from my commentaries. Indeed, I said 3 weeks ago when discussing the weekly key reversal up last week that if it was an up, then I would, and I quote, most likely retire both secondary targets below as well as the new interim target, end of quote. Well, for the last few weeks, I have kept all three targets still on my daily chart, but put them under notice. This week I've decided to only keep the targets below, but I've not decided in my mind yet as whether or not to still keep them under notice of retirement. Finally, this commentary would not be complete without my discussing the elephant in the room, or at least the elephant in the room which has overstayed there throughout 2024 and also resonates now into 2025. And that is the annual key reversal seen here at the end of 2023. I said, and I'm afraid I have to repeat something I haven't highlighted now for 92 weeks, so coming up for nearly 2 years, and I quote, I now only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we've been living in the shadow of this pattern ever since, end of quote. And I've also added ever since, and I quote, there's only one thing to take away from any of my musings, let it have been those words, end of quote. These last few weeks have shown that the shadow cast by that supremely significant pattern so long ago still darkens the skyline of this market today. Chicago soybean oil. A continuing theme, as per last week, of a somewhat clearer chart this week when compared to earlier weeks. The main pattern here is still the bright red, shallow, bullish shift pitchfork with a mid-September to late December 2025 move. The market is right now in between the bright red lower time below, currently at 40.51, and the bright red middle time above, currently at 45.61. Okay, so recently with changeover, we saw a small gap higher 2 weeks ago, followed by a further move higher over the congestion at 42.52 and 42.67, being the May and April 2024 lows, respectively. The move up was very unsurprising, capped last week by and I suppose this week also, on a closing basis by, of course, the flatlining golden long moving average, currently at 43.44, and supported on an opening basis by the 42.52 May 2024 low. Further up we have the also flatlining mauve medium moving average, currently at 43.84, lodged right now in between the significant 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94. Whilst below we have congestion at 41.15, much as we had 2 weeks ago. Now, as I have pointed out extensively in my video commentaries, the market has seemingly decided upon a huge, large-scale June 24 to February 25 triple top pattern, offsetting what could have been a huge June 24 to February 25 double bottom. So that after these have offset each other, what have we left? We have just the main pattern, the bright red shallow bullish shift pitch hook, at least for now.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.